So we are going to be looking at adjusted present value. One thing you need to understand is that the adjusted present value, or APV, is closely related to the net present value. The same way the examiner will set question under NPV is the same way it will be set under adjusted present value. But I'm going to show you, I will demonstrate the distinctive feature of APV so that when you see it on the day of your exam, you will know that this is APV. Therefore, what do you understand by adjusted present value? The adjusted present value is a technique that is designed to evaluate a project when financial risk or debt equity proportion of a company is expected to change as a result of undertaking a project. I take it again. APV is a technique that is designed principally to evaluate a project when financial risk or debt equity proportion of a company is expected to change as a result of undertaking a project. So APV and NPV are similar. However, what differentiates APV from NPV is issue costs as well as a subsidized loan. Which means that if in a question you are given issue cost, or you can see subsidized loan, you need nobody to tell you that you are supposed to calculate adjusted present value, because NPV does not consider itself with issue cost or subsidized loan. It is only APV that makes use of issue cost. So that is the only thing that will make you to know that the question relates to APV. Once you see issue cost or subsidized loan, it is APV that you are going to calculate, because APV is a technique that separates cash flows from operation from the cash flow arising from financing and appraise each independently. So that is basically the introduction to adjusted present value. But one thing you need to understand is that APV should be used when issue costs or subsidized loan is given. Because on the day of your exam, if you have question on APV, examiner may not tell you. In most cases, you are not going to be told. Okay, you are not going to be told to calculate APV. Examiner can ask you to evaluate, assess, advise. So APV may not be mentioned. So you should be able to know. Once you see issue cost of subsidized loan, you should know that it is adjusted present value that you are going to calculate. Now, how do you then compute APV? When you want to compute APV, there are basically 4 procedures that you are going to carry out. There are 4 procedures of calculating APV. The first one is to calculate base case NPV. Step 2, you calculate present value of financing effects, cash flow. Step 3, you calculate APV. Step 4, you advise on the financial viability of the project or on the acceptability of the project. So those are the 4 procedures that you are going to carry out whenever you want to compute APV. I repeat, the first step is to calculate base case NPV. Step 2, you calculate present value of financing effect cash flow. Step 3, you calculate APV. Step 4, you calculate the PV. Sorry, you advise. That's step 4. You advise on the acceptability of the project. Each steps has its own sub procedures that you are going to carry out. So how do you compute base case NPV? How do you compute present value of financing effect cash flow? How do you compute APV? So each of them has its own underlying procedures. So when you want to calculate base case NPV, to calculate base case NPV, there are 4 procedures you are going to carry out. The first step is to determine relevant cash flow. You determine relevant cash flows, including sales value, variable costs, contribution, working capital, initial outlay, specific or attributable fixed costs, scrap value, inflation, taxation, all those things you normally do whenever you want to compute NPV. It's the same thing that you are going to do when you are calculating base case NPV. So that's the first thing. The same way you calculate your net cash flow under NPV is the same way you are going to do it under the base case NPV. And that's what I said, you should calculate the net cash flow. Okay, you calculate net cash flow. I can't use my pen. Let me use the one I have. I'm using a mouse. Okay, so you calculate net cash flow for each year. Then step 2, under the base case NPV, is to calculate cost of equity loan gear. To calculate the cost of equity loan gear, there are 3 ways that you can do that. You know, when you want to compute your NPV, normally you are supposed to discount the future cash flows using the WACC of the company. But when you are calculating the base case NPV, you don't use WACC of the company. Rather, you use the information of the proxy company to do that. So depending on the information of the proxy given to you, that will tell you the cost of equity ungeared that you are going to calculate. This cost of equity must be ungeared. Anything that has to do with financial risk should not be involved. So you have to remove everything, anything financial risk should be removed. So that's why it is called cost of equity ungeared. Now, like I said, when you want to calculate the cost of equity loan gear, there are 3 different ways you can achieve that, depending on the information available. If you are given beta value of a proxy, if beta of a proxy company is given to you, then there are 3 procedures you are going to carry out. The first procedure will be to identify the proxy beta. Okay, you identify the proxy beta. Then step 2, you ungear the beta if it is geared. Then step 3, okay, step 3, you calculate cost of equity on gear using capping. So those are the 3 procedures that you are going to carry out. I don't have that in this material. I don't know what's wrong with this. The pen. Yes, I don't know. Okay, let me see if I can restart. Let me restart so that I can the pen can pick up again. Because I'm supposed to explain that I can't use mouse to be writing on the screen. Because this other one that I mentioned, if beta is given, so the procedure is not here. And then I need to write it out. So give me 1 minute, please. So like I was trying to say, so when you are calculating the cost of equity on gear, there are 3 procedures depending on the information available. So if the beta of a proxy company is given to you, if beta of a proxy is given, then there are 3 procedures. The first procedure is to identify the proxy beta. Identify the proxy beta. Then step 2, you ungear the beta if given. So if geared, ungear the beta if geared. You already know how to ungear it. All right. Then step 3, you calculate cost of equity ungeared. Calculate cost of equity ungeared, that is capping. So these are the 3 procedures that you are going to carry out if beta of a proxy is given to you. Then step 2, another way you can calculate cost of equity ungeared is if you are given the cost of equity of a proxy company. All right. So if cost of equity of a proxy company is given, then of course we are going to calculate the cost of equity using Miller and Modigliani formula. We use Miller and Modigliani formula. All right. Okay. So this is the Miller and Modigliani formula that you are going to use. Once you are given cost of equity of a proxy company, then you will recall that when we had cost of capital, under cost of equity, I mentioned to you that there are 3, I told you that there are 3 methods of calculating cost of equity. 1 is dividend valuation model, 2, capital asset pricing model, then 3, Miller and Modigliani formula. So this is the Miller and Modigliani formula I was referring to. And I told you then that when we get to APV, we are going to make use of that Miller and Modigliani formula. So this is the formula you have here. Okay. So KEG is the cost of equity of a gear. This KEG will surely be given to you. What you are looking for is the cost of equity on gear. So KD is the coupon rate on the debt or on the loan. Is the interest rate on the debt. All right. So if the cost of debt is not given to you, then you are going to assume risk-free rate of return. I repeat, where cost of debt is not given to you, you assume risk-free rate of return. Okay, then D is the market value of the debt. It could be bond, it could be debenture. Then E is the market value of equity. Of course, T is the company tax rate. So that is that. Then the third one is if you are given the WACC of a proxy company. If WACC of a proxy company is given to you, then you need to calculate WACC of on gear. So let me put it here. So before that, let me just rewrite this. Number B, if cost of equity of a proxy is given. So if you are given cost of equity of a proxy, like I said, you are going to use Miller and Modigliani formula, which is cost of equity of a gear equal to cost of equity on gear plus, open a bracket, cost of equity on gear minus cost of debt multiplied by debt value into 1 minus tax, all divided by equity value. So this is the Miller and Modigliani formula. Then the third one is if you are given WACC of a proxy. Number C, if WACC of a proxy is given. So if WACC of a proxy company is given to you, then the WACC of a gear is equal to WACC of on gear multiplied by 1 minus debt value multiplied by tax. Let me push to the right. Multiplied by tax divided by equity plus debt. Okay, this one will come here 1 minus. So this is the formula that you are expected to use This is the formula that you're expected to use to calculate work of on gear, which is, of course, note that work of on gear is the same thing as cost of equity on gear. Mr. Chwaju would have taught you this under capital structure, theories of a journey. Okay, theories of journey. So would have taught this same formula, would have used it for you. All right then. So of course, D remains as the value of debt, T is the tax rate, E is equity value. So work of a gear, this will surely be given to you. What you are looking for is the work of a gear. All right. So that's it. So these are the three ways in which you can calculate the cost of equity on gear. Now, after you have computed the cost of equity on gear, remember, I said there are 4 procedures of calculating base case NPV. The first step is to calculate net cash flow, all right? You calculate net cash flow, NCF. After you calculate net cash flow, the second procedure is to calculate cost of equity on geared. You calculate cost of equity on geared. And I told you that to calculate the cost of equity on geared, it will depend on the information of a proxy company given to you. So if you are given beta of a proxy company, these are the procedures you are supposed to follow. If you are given cost of equity of a proxy company, this is the formula you are supposed to use. If you are given WACC of a proxy company, this is the formula you are expected to use. Then you then move to step 3. Step 3 is to calculate present value. To calculate present value. How do you do that? You calculate present value of cash inflow and present value of cash outflow. Then step 4, you calculate the base case NPV. You calculate the base case NPV. I hope this is not valuation, because let me see. I was wondering that's the procedure. Is this? Yeah, it's value. I'm using valuation because they're related. Let me search again. I'm using valuation APV to explain. Let me try it again. APV. Because I was wondering that the procedures I have there. This is it. This is the one I'm looking for. It's on page 53. Sorry, it's a mix-up. It's on page 53. That's the one of 105, the one we'll be using, that one is meant for valuation. But even though they are the same, yeah. So that's what I was writing out all those formula again, because I know I'm supposed to have given. So these are, you just go back and this is what I've already explained this. So yeah, that's it. So like I said, you just calculate base case NPV, which is the total present value minus present value of cash outflow for whatever you have. That will give you your base case NPV. But like I said, the base case NPV is the same thing as the normal NPV. The same way you calculate normal NPV is how you are going to, is the same way you are going to calculate the base case NPV. The only difference is just that instead of you to discount your net cash flow with the company's WACC, you are supposed to discount your net cash flow using cost of equity on geared. And how to calculate the cost of equity on geared, I've already demonstrated that. Then let's move to present value of financing effect cash flow. Let's explain present value of financing effect cash flow. So whenever you want to calculate present value of financing effects, there are some preliminary steps that you are supposed to take. The first thing you are going to do is to ascertain whether you want to use cost of borrowing or risk-free rate of return as a discount rate for the financing effect cash flows. I repeat, when calculating PV of financing effect cash flows, you need to ascertain whether you want to use cost of borrowing or risk-free rate of return as a discount rate for the financing effect cash flow. So whatever your assumption you want to use, what is important is that you just have to state it in your in your answer booklet, you need to state your assumption, whether you want to use cost of borrowing or you want to use risk-free rate of return. But I will advise you to always use cost of borrowing, because cost of borrowing will always be higher than the risk-free rate of return. Then again, second thing that you need to do is to ascertain, or you determine, or you decide whether you want to use gross finance required or net finance required. Ascertain whether you want to use gross finance required. Okay, let me see. Let me, so that I don't deny you. Let me stop sharing this, and let me stop sharing this so that I can fully explain, because the only area of technicality as far as APV is concerned is the PV of financing effects. And if you don't get it right, you are going to struggle. So let me share my screen again, my workbook, so that I will explain in details how to calculate PV of financing effects. So like I said, calculating PV of financing effects, cash flow. That's the heading. So to do this, the first thing you are going to do is to decide whether to use cost of borrowing or risk-free rate of return. So whichever one you want to use, so it's what examiner will mark for you. Then number 2, ascertain whether to use net finance required NFR or gross finance required GFR. In most cases, examiner will not tell you whether you should use gross finance or net finance, but at all time, always use the gross finance required. All right. How do you calculate net finance required or net finance required or gross finance required? The net finance required is calculated as initial outlay plus working capital. Okay, that will give it the net finance required. So this working capital will be the working capital of year 1, at beginning of year 1, which is the same thing as year 0. So it is assumed that the subsequent working capital will be financed with the cash flow generated by the project. So that's the assumption. Then the gross finance required will be computed as the net finance required divided by 1 minus issue cost rates. 1 minus issue cost rates. So that will give you the gross finance required. Okay, so note, let me explain that. Note, ICR equal to issue cost rates. All right, so that is that. Then step 3, you then calculate the PV of issue cost. Calculate the present value of issue cost. How do you do this? before you calculate the present value of issue cost, you need to know what is issue cost. Issue cost represents the cost of underwriting and raising debt and equity capital. Okay, issue cost represents the cost of underwriting. Let me just put it down. The issue cost represents the cost of underwriting and raising debts and equity capital. Okay, including the examples of issue costs include marketing expenses, audit fee, legal fee, registration fee, this is the registration fee paid to the Security and Exchange Commission. Then we also have investments, banking fee. Now, let me explain some of the issue costs. You know, when a company wants to raise capital, say, for example, you want to go public, initial public offer, the company needs funds, and that's why the company is going public to raise the finance required. Therefore, the company cannot just go to the markets and start raising the money. There are some intermediaries that will stand between the company and the public to get the needed capital. So that is the investment bankers. They are the one that will stand as an intermediary. So the fee you pay to the investment bankers is what is known as investment banking fee. Again, when the company wants to raise the finance, the company will need to prepare audited financial statements. So the auditor that will audit the financial report, of course, the fee you pay to them is not for free. I mean, the work they are going to do for you is not for free, so you need to pay. Not only that, all relevant all the supporting documents that will be submitted to the Security and Exchange Commission and other regulatory bodies, we need to be reviewed, all right, by the legal by the legal by a lawyer or barrister or whatever. So the fee you pay to the barrister or to the lawyers is what, of course, it's not. It's also part of the issue cost we are talking about. Not only that, when you want to raise the finance, you need to promote it on social media, in all the media houses or some of the media houses. You will recall that since last year, since February last year, when is it February or April last year, since the recapitalization exercise from the banks has commenced, most of the banks have been promoting it in the public, sensitizing the people to come and subscribe for their shares. All right. So all those expenses incurred before the finance is received is what is known as issue cost. So the issue cost will start is a cost incurred at the beginning of the project. So that is that because of time. So that is as per issue cost. Now, how do you then calculate issue cost? To calculate issue cost, there are three procedures there are 3 or 4 procedures that you are going to carry out. The first procedure is to determine the issue cost amount. Okay, let me put it down. To determine issue costs, to determine the PV of issue costs. To determine the PV. Oh, this thing has started again. Okay. The PV of issue cost. The first thing you are going to do is to calculate the issue cost amount. Calculate the issue cost amount. ICA. How do you calculate issue cost amounts? Issue cost amounts, ICA, is calculated as the gross finance required multiplied by issue cost rates. So you are going to multiply the percentage of issue cost on the gross finance required. So that will give you the issue cost amount. Then step 2, you calculate the PV of issue cost in year 0. Calculate the PV of issue cost amounts in year 0. This will be in 2 folds, depending on the information available. If in the question you are given debt and equity, then you are going to calculate issue cost amounts on debt, which should be calculated as the issue cost amounts on debt multiplied by discount factor at year 0. Whatever you have, put it down. Then you then calculate issue cost amounts on equity, which is equal to issue cost amounts on equity multiplied by discount factor at year 0. So whatever you have, put it there. Of course, this will always be in brackets because it's a cost, it's a cash outflow. It will always be in brackets. Now, remember from the definition of issue cost, we said issue cost represents the cost of underwriting and raising debt and equity capital. So if you have both, so like I was trying to say, so say for example, after you have computed the net finance required, whatever you have here, that's your net finance required. So you are going to multiply to get the value of the debts of the net finance required. So you multiply the total net finance required, you multiply with the percentage of debts. You do the same thing for equity. You multiply the net finance required with the percentage of equity. So that will give you the net finance required on debt as well as on equity. Before you now determine the gross finance required on equity, gross finance required on debt. So when you are now calculating your issue costs, present value of issue cost, when you get to this place, that's what you are going to be using. The gross finance required on debt, the gross finance required on equity, the issue cost amount. All right. So the issue cost amount you are going to get here will be in 2 folds. One for debt, one for equity, because the percentage of the debt, the percentage of issue cost rates or the issue cost rate on debt will be different from the issue cost rate on equity. So you are going to multiply the percentage on the gross finance required of each of them. So when we have live question, I will be explaining more on that. All right. So the next thing you are going to do is to calculate the present value of tax saved on present value of tax saved on issue cost amounts on debt for year 1 only. Because anything that has to do with debt, we have tax deductibility benefits. So number 3, you calculate PV of tax saved PV of tax saved on issue cost amount on debts of issue cost amount on debts. Okay, so how do you do this? You are going to multiply issue cost amount of debts. You multiply with the, remember we said tax saved, so you multiply with the company tax rate. Because you want to calculate present value, you also multiply with the discount factor at year 1 only. Okay? So whatever you have here, you take it to your right. Then you now find the difference. Usually it will be negative. So this should then be the PV of issue cost. Okay, that would be the PV of issue cost. Then that is one. The next one, let me use Roman figure here so that will be different. Roman figure 2, Roman figure 3. Now, step 4. But if in this step 3 of PV of issue cost, if you don't have equity in the question, in most cases you may not have equity, then you only calculate for debt. In this case, it will be just 3 steps. So just calculate the issue cost amount. Then step 2, calculate PV of issue cost in year 0. Then of course, that is only for debt. Then you calculate the PV of tax saved on issue costs in year 1 only. So nothing for equity if you don't have it. Now, number 4, the fourth step you are going to carry out when you are calculating APV is to calculate the PV of net subsidy. PV of net subsidy. So you only do this if you are given subsidy in the question. If there is no subsidy, you just ignore it. But if you are given subsidy, you need to calculate it. There are 4 procedures you are going to carry out. The first step under net subsidy is to calculate the amount attributable to subsidy. Determine the amount attributable to subsidy, or let me put it this way, determine subsidy amounts. That would be more straightforward instead of saying amount attributable to subsidy. Determine subsidy amounts. Essay. How do you determine subsidy amounts? Essay is equal to the gross finance required. That is if you are using gross finance required. If you want to use net finance required, it will be net finance required multiplied by the proportion. Multiply by the proportion of subsidy. So examiner will surely give you the proportion of subsidy. You may be told that out of the gross finance required, 60% is for subsidized loans, 60% is subsidy. So if 60% is subsidy, it means 40% is for normal borrowing. So if 30% is for subsidy, 70% is for normal borrowing. So you must know how to interpret that. Then the next step is to calculate savings on subsidy. Calculate savings on subsidy. SOS in percentage. How do you do this? SOS will be equal to the subsidy amount multiplied by 1 minus tax rates. Sorry. This should be, when you talk about savings on subsidy, anything that has to do with subsidy will always come at a cheaper price because it has been subsidized. Therefore, you are going to find the difference between the normal borrowing rates, the interest rate, the difference between the interest rates that you borrow in the markets, normal borrowing rates minus interest rates on subsidy. So that will give you the saving on subsidy. The NBR is the normal borrowing rate. SR is the interest rate on the subsidized loan. Then step 3 will be to calculate net subsidy. Calculate net subsidy. NS. The net subsidy will be calculated as subsidy amount multiplied by savings on subsidy multiplied by 1 minus tax. Okay, so this will give you the net subsidy. Then step 4 is to calculate the PV. Calculate the present value of net subsidy. So the present value of net subsidy, PV, will then be equal to the net subsidy multiplied by annuity factor. Remember what I said, in your step 1, you need to decide whether you want to use borrowing rates or you want to use risk-free rate of return to discount the cash flow arising from financing. So all this present value you are calculating, you are using the either borrowing rate or risk-free rate of return. And I've told you, you should always use the borrowing rates because borrowing rates will always be higher than the risk-free rate of return. Then the last step under the PV of financing is to calculate number 4 or 5. Let me see, number 5 is to calculate the PV of tax saved on interest. So to calculate the PV of tax saved on interest, there are 3 procedures. Step 1, you accumulate all interest elements. Anything that has to do with interest. How do you do this? You calculate interest on normal borrowing. How do you calculate interest on normal borrowing? Simple. You are going to multiply the normal borrowing rates, you multiply with the loan, the proportion of the debts, okay, the proportion of the debts. Then you also calculate whatever you have there, put it here. Then you also calculate the interest expense on subsidized loan, on subsidy, interest on subsidy. How do you do this also? To get the interest on subsidy, you are going to multiply the interest rate on the subsidy, you multiply with the proportion of subsidy, multiply with the subsidy amount. Okay, so whatever you have, put it there. You then add the two together, that will be the total interest. So with this, you have accumulated all interest elements. After that, then move to step 2. Step 2 is to calculate tax saved on interest. Calculate tax saved on interest. How do you do this? To get the tax saved on interest, you multiply the total interest with the company tax rates. That will give you the tax saved. Then step 3, you calculate PV. Calculate the PV of tax saved on interest. How do you do this? Simple. Just multiply the tax saved with the annuity factor. That's all. Whatever you have, that will be your PV of tax saved. Then you then move to step 6. Step 6 is to calculate PV of financing effects. Calculate PV of financing effects. Cash flow. How do you do this? You've already calculated each component of the financing effects. Therefore, you go ahead and pick the PV of issue cost you have calculated in step 4. So in step 3, PV of issue cost. You put it here. You also calculate, you pick the PV of net subsidy. Put it there. You take the PV of tax saved on interest. So put it there. You add everything together. It could be positive or negative. This represents the PV of financing effects. So that is how to calculate PV of financing effect. It may look cumbersome. That is APV for you. Just take your time to master the procedures and you'll be fine. It's not difficult. Once you take your time, understand the procedures, then you solve practical questions and you'll be fine at the end of the day. Then, the next thing we are going to do is to move to step number 3 of the calculating of APV. Remember, step 1 is to calculate the base case MPV. Step 2 is to calculate, okay, let me call this one B. So step A is to calculate base case MPV. Step B is to calculate present value of financing effect. All what I've been discussing since are present value of financing effects, which is our 6 procedures. Then step C, you calculate APV. Calculate adjusted present value. How do you do this? Simple. To get the adjusted present value, you pick the base case. Net present value you have computed in step 1, put it there. You add or minus the PV of financing effects, cash flow. So it could be positive or negative. Whatever you have, your APV may be positive or negative. That is the adjusted present value. Okay. So that's how to calculate the adjusted present value. Then you now make a decision. Step 4, about dinner, decision, your advice. Decision rule. 1, If APV is positive, you accept the project, just like the same decision rule with MPV. If APV is negative, you reject. So where you have 0 MPV, you can either accept or reject depending on other qualitative factor. If 0 APV, accepts or rejects depending on other qualitative factors. So these are the procedures that you are going to carry out whenever you want to compute APV. You can see it's a big one and it's very technical. So it's very technical, especially for the present value of financing effect. So that is adjusted present value procedures and the concept. The next we want to do is to, of course, we can't do the calculation today. We can't solve more than one illustration because it's a big one. And yeah, this is where we are going to call it a day. In our next class, by the grace of God, we are going to do calculation of APV. So please take your time to review. Take your time to review what we have done today, especially on this APV, so that you have good insight of the concept. You understand once you understand the concept, no matter how big is the question, you surely get the right answer. If you don't get the 100% of the question correctly, you'll be close to the 100%. So please take your time, review the procedures, and that's it. So let me know if you have any question for me before we close the class.
No
Any question for me?
from me.
Okay. Yes. Chidima, Diamond, Wumi, Tintin, Ufoma, Wellington. Pascal has disappeared. Pascal and Biola, they have disappeared. Any question for me? If
No,
not,
sir.
Hello, sir.
okay. Yes, Wumi, talk to
The
me.
only question I would have loved to ask is, has this
Yeah.
APV ever been tested as a compulsory question?
It has always been compulsory.
Wow.
Though it's been a while that I can tested it. The last time it was 2019 November. 2019 November. Yeah. Ever since then we'll be expecting it, but I can refuse to test it.
We are not expecting it. We should not be.
You
When
better
I
do,
pass, they can now bring it back.
you better don't do don't say that. It may well be that the one you are running for is the one I can will test on that day. 30 marks.
You go and leave my secret to ICAN.
It's not difficult. Seriously, it's not. Just take your time, review it, and it's not hard. It's not hard, especially if if you use the golden book. It's well explained, highly explained. APV used to be very difficult, but since after I published the golden book, everything has been simplified. But in any case, that is it. So by the grace of God, in our next class, we are going to solve question under this. So once we are done with APV, we may likely do portfolio theory, okay? We do portfolio theory. I can spend the remaining minutes that I have after calculation of the APV question. So I can spend the remaining minutes to explain the concept of portfolio theory. Okay, so in the absence of no further question, I want to say thank you to all of you. I will see you next time by the grace of God.